Today's podcast episode of Simple Mind Space focuses on the current state of the economy and potential warning signs of a recession. The host, David Rosenberg, starts by acknowledging that some indicators are flashing red, and he wants to dive deep into the specifics. One of the first points mentioned is that the personal consumption expenditures, PCE, came in as expected, and unemployment rates are holding steady. Additionally, earnings reports have surprised on the upside, even though stock performance hasn't followed suit. However, Rosenberg points out that earnings from the last quarter are in the rearview mirror, and earnings estimates for the rest of the year have been coming down over the past couple of months. This means that the recent stock market gains have been driven by multiple expansion rather than improving fundamentals. When it comes to the consumer, Rosenberg acknowledges that consumer spending has exceeded expectations. However, he highlights a concerning trend of a growing money divide. Real consumer spending, after adjusting for taxes and inflation, has only grown 1% over the past year. Furthermore, there has been a relentless decline in the personal savings rate, which currently stands at 2.9%, the lowest it has been in the past 5% of the time. Rosenberg emphasizes that the consumer spending report is not generated by real income growth, but rather by a drawdown of the savings rate to low levels. This raises concerns about the sustainability of consumer-driven economic growth. Moving beyond the consumer, Rosenberg discusses the recessionary signals in other sectors of the economy. He mentions that business capital spending is in a recession, the industrial sector is in a recession, and the housing market is rolling back into a recession. While these sectors are not the biggest components of the economy, they do indicate areas of weakness. Regarding the unemployment rate, Rosenberg notes that it has gone up by 80 basis points, catching the attention of Federal Reserve Chairman Jerome Powell. This is one of the most important statistics for Powell at the moment, as job loss could indicate a deeper economic downturn. When asked about the Federal Reserve's response to the current economic situation, Rosenberg believes that the Fed is behind the curve. He points out that the Fed's own estimation of the neutral rate is around 2.75%, while the current funds rate is at 5.83%. This suggests that the Fed's rate is not in line with the normalized economy. In terms of the timing of a potential recession, Rosenberg believes it is a no-brainer that the Fed is behind the curve. He suggests that the recession, if it occurs, could be either in the first quarter of next year or the fourth quarter of this year. Shifting the discussion to investment strategies, Rosenberg agrees with the idea of defensive plays in the market. He mentions sectors like gold, healthcare, and utilities as areas to consider. However, he acknowledges that these sectors have already experienced re-rating as investors anticipate a cooling off of the economy. Rosenberg concludes by emphasizing the importance of monitoring interest rates and how they impact different sectors of the economy. He believes that as rates continue to come down, sectors with defensive and growth characteristics will likely be re-rated positively. In summary, today's podcast episode highlighted the warning signs present in the current economy, including declining earnings estimates, a growing money divide among consumers, and recessionary signals in certain sectors. While the consumer is still performing well, there are concerns about the sustainability of consumer-driven economic growth. The Federal Reserve is seen as being behind the curve, and the timing of a potential recession remains uncertain. Defensive plays in sectors like gold, healthcare, and utilities are suggested as potential investment strategies. However, it is important to monitor interest rates and their impact on different sectors.